The Bank of England just said what nobody in Silicon Valley wants to hear. The AI bubble might be about to pop, and your wallet's gonna feel it. Look, AI is everywhere right now. ChatGPT, self-driving cars, robots doing your homework. Companies are throwing money at anything with AI slapped on it. OpenAI is worth $500 billion. That's more than McDonald's, Coca-Cola, and Netflix combined. But the Bank of England just dropped a warning that should make everyone pay attention. When one of the world's most powerful financial institutions says there's a growing risk of a sudden market crash, they're not joking. So, what's really happening behind the AI hype, and what happens if this whole thing comes crashing down? Over the past couple years, we've seen something that looks a lot like the dot-com bubble. OpenAI was valued at $157 billion last October. Now they're at $500 billion. Anthropic went from $60 billion in March to $170 billion last month. They almost tripled in less than a year. These aren't normal growth numbers. This is pure rocket fuel. Tech giants are pouring billions into AI infrastructure. Everyone wants a piece. But here's the problem. The Bank of England just said stock prices, especially for AI companies, might be way too high. And when prices are stretched too far, they snap back hard. The bank warned that equity market valuations appear stretched, particularly for AI companies. They said if expectations around AI become less optimistic, things could get ugly fast. And here's the scary part. Investors haven't fully accounted for these risks. When reality doesn't match expectations, financing dries up for everyone. Harder to get loans, harder to buy homes, harder to start businesses. Now here's the evidence that should worry people. MIT researchers found that 95% of organizations are getting zero return from their AI investments. Let that sink in. 95%. Zero return. Companies are spending billions on AI tools and seeing nothing back. If that's true, why are these stocks worth so much? Even if AI lives up to the hype, there are massive bottlenecks nobody's talking about. First, power. AI needs enormous amounts of electricity, data centers using as much power as small cities. Can the grid even handle this? Second, data. AI needs tons of data to train on, but we might be running out of quality data. Third, supply chains. Building AI requires rare materials from unstable regions. Any disruption causes problems. And here's the kicker. What if someone figures out a completely different way to build AI that doesn't need all this expensive infrastructure? Suddenly billions in current technology become worthless. It's happened before in tech. As if that wasn't enough, there's the Trump factor. He keeps attacking the Federal Reserve and threatening its independence. The Bank of England warned that if the Fed loses credibility, US stocks, bonds, and the dollar could plummet. And because the dollar is the world's reserve currency, everyone everywhere feels the pain. Your investments, inflation, grocery bills, everything gets hit. Add this to Trump's trade wars, which haven't fully played out yet, and you've got a recipe for serious instability. If markets correct suddenly, several things happen fast. Your retirement accounts and savings lose value. Banks stop lending. Companies start laying people off. Consumer confidence drops, and the economy slows down. Here's the thing about bubbles. They don't deflate slowly. They pop. When everyone realizes prices are too high, they all try to sell at once. Markets can lose 20, 30, even 50% in months. It happened with .com. It happened in 2008. It could happen again. Does this mean AI is useless? Number. AI is real technology doing real things. It's helping doctors, scientists, making our lives easier. The problem isn't the technology. The problem is the gap between expectations and reality. The problem is prices that don't match actual value. Think of it like buying a house. The house is nice, but the seller wants 10 million for something worth maybe 2 million. Same house, wrong price. That's AI stocks right now. Good companies, important technology, but prices that are way too high. That 95% figure from MIT is a massive red flag. If almost all companies see no return on AI investments, something's seriously wrong. Either companies don't know how to use it, or the technology isn't as revolutionary as promised, or we're decades away from real returns. None of those justify current valuations. Nobody can predict exactly when a correction happens. It could be triggered by one disappointing earnings report, a crisis, or just slow realization building to a tipping point. But the conditions are there. Valuations stretched, expectations unrealistic, risks ignored. The Bank of England is saying the warning lights are flashing. For investors, be cautious. diversify. Don't put everything in tech stocks. For businesses, be skeptical about AI investments. What's your actual expected return? For regular people, stay informed. Have an emergency fund. Don't take on too much debt. Economic cycles are normal. What goes up comes down. The AI revolution is real, but revolutions are messy. The question is whether current prices make sense. And increasingly, the answer seems to be no. When everyone tells you something can only go up, that's when you should be most careful. Subscribe for more such videos and click on bell icon to get updated.